Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. With a roll and rate strategy at Salomon Brothers in the late 90s, Subadra Rajappa developed an early appreciation for how market risk can be transmitted around the world through the 97 Asian FX crisis and the LTCM debacle a year later. Over the course of a career spanning more than 25 years, she's developed a macro framework underpinned by an assessment of growth and inflation variables that help drive interest rate fair value models. Derivative market pricing and fund flows also make their way into her framework. Specifically, Subadra looks at the interest rate vol surface, with special attention paid to the price of out-of-the-money options, and to track the money, she keeps an eye on positioning in futures markets. Our conversation considers key recent events that shape where we are in the monetary policy cycle. In this regard, Subadra shares her views on the integrity of market pricing signals amidst the large participation of the Fed in the market itself. We also explore inflation, and here Subadra points out that while some components of the rise in inflation will prove transitory, others, like wages, tend to be more persistent. A vulnerability that results is the potential of a less market-friendly Fed in 2022. Lastly, I solicit Subadra's perspective on the degree of progress in promoting the career growth for women in the financial industry. To this, she sees more attention paid to recognizing women and hiring them, but there remains a lot of work to be done on the retention front. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Subadra Rajappa. My guest today on the Alpha Exchange is Subadra Rajappa. She is the head of U.S. rate strategy at SocGen. Subadra, thanks for being a guest today.
Thanks for having me, Dean.
Absolutely. Well, I'm excited to have this conversation, and our guests will definitely value your insights on all things relating to the many mysteries out there with respect to growth and inflation and the Fed and tapering. So lots for us to explore in the present day. And also, I think we'll explore some of the history of risk events as well. Tell us a little bit about you and your career, the early days in the industry for you. How did you get started in finance?
That's actually a good question because my background is in engineering and computer science. So the switch to investment banking was kind of by accident. I happened to get a job at Salomon Brothers because of my quantitative background, and I started there in finance in the mid-90s. It was definitely a very, very exciting place to work at that time, given the fact that, we had a lot of colorful personalities in the business. Finance in general was exciting. There was a lot of financial engineering that was going on. So very exciting times, and I kind of caught the bug and I continued on with my career in finance.
Well, you had a front row seat there in the late 90s, being at Salomon Brothers and being in rates to some of the implosions that occurred, specifically long-term capital in 1998. They were, of course, expats from the Salomon period. I'm curious, I know it goes back a long, long ways. But for me, that was a personally kind of formative risk event just to see markets get so dislocated in such a short period of time. What are your recollections of that and just of that sort of general period in the late 90s with respect to rates?
That's right. That's the team that I started my career in at Salomon Brothers. A lot of people in the team that I started in left to go to LTCM. And like you, I think the LTCM crisis was formative for me in trying to understand, how markets react. I mean, it started off kind of in a benign fashion, if you remember, with the Asian crisis. And then before you know it, it went from Thailand to becoming the LTCM crisis, and in a very short amount of time. So it was definitely something that was very instructive on kind of contagion and how quickly things can spread from one part of the world to the other.
And what's so interesting as well is, you'll recall, I guess it was around maybe September or October of 98, the Fed comes in and kind of cajoles the counterparties for long-term capital to put up some capital to form a new entity and effectively guide this beast of a portfolio to safety. And so it's interesting to sort of see the Fed as a market participant at points in time. And I think we'll talk plenty about that in the here and now of things like quantitative easing and some of what they did during the pandemic. So you spent some time at Salomon Brothers. What was your next move after that?
So Salomon Brothers kind of morphed into Citigroup. I stayed on with Citigroup till the financial crisis. And then after that, I worked at Morgan Stanley. And then after my stint at Morgan Stanley, I've been at SocGen since 2014, late 2014.
Great. Well, let's explore a little bit of the framework that you've developed over time. So you've been looking at markets for a long time, and we've seen mostly rates go down over that period of time. We'll sort of see what comes next, but it's been a long cycle of lower and lower rates. And whether they're policy rates or long-dated rates, it's just amazing how far we've come. But maybe you could just give us the broad framework with which you approach markets, just in terms of the macro variables that are instructive to you, the things over time that have stayed with you in terms of things you look at that, craft your view on markets. How would you describe the framework that you use to look at markets?
So I think the best way to start is from the fundamentals. For me, it's the economy, the macroeconomic backdrop. For instance, in the current environment that we're in, there are a variety of external factors. And so this is very unusual, a period where, we're tracking what's happening with the viruses. We're tracking what's happening on supply chain constraints, mobility rates, not just in the US, but also globally. So a lot of these factors feed through into formulating, I would say, the fundamental starting point of how we come up with our investment thesis. We also rely on a bunch of models. We have fair value models for rates as well as currencies. And we look at the options market very closely, both implied volatility of rates as well as volatility skews, which tell you sort of the pricing for out-of-the-money options, tend to be very, very good indicators of the market's collective outlook on the directionality for the rates market. And the other important component that we use is sort of tracking positions. Positioning in futures, positioning in other markets, where the money is going, inflows and outflows into investment funds, tend to be sort of very important metric to keep track of, because that, again, informs your views on how you should be looking at where to put your money to work. And of course, the key driver here is the guessing game on central bank policy outcomes. Since, as you mentioned earlier, Dean, central banks have become a very central part of investing and the philosophy of what drives the market. So we also track central bank policy very closely.
Well, that gives us a lot to focus on. That was excellent. And I was hoping we would start with late 2018, because this was, in some people's rendering, a little bit of a turning point with regard to the way in which the Fed and the market interact, perhaps sometimes in an unhealthy fashion. So the Fed is going about its business tightening policy. It does that one last turn right around Christmas time of 2018, and the market goes into a little bit of a free fall there. And just as soon thereafter, Powell has relented and we're easing by July of 2019. So it was a pretty significant about phase. So I'm just wondering if you could go back to that period and tell us what was on your mind during that period, because in some ways it was a little bit of a turning point in terms of what we can expect the Fed can accomplish in terms of tightening. Tell us about that from your standpoint.
Yeah, I think that, in some respects, after the fact, the Fed realized that they had tightened monetary policy too much. And, they started to be concerned about the general trajectory for growth and inflation. And very quickly, the market sensed those uncertainties that are around the bend. And we saw this very sharp correction in yields. And before we know it, we were in the pandemic. And then the Fed had to do another very sharp correction in early 2020 and bring interest rates all the way back down to zero. So I think that, there were a few factors that were at play in 2018. It was not just the interest rate hikes, but also the balance sheet. And the Fed started sort of reducing its balance sheet for the first time. And I think that was also starting to tighten monetary policy. And as you might recall, Dean, there was a time when, even though excess reserves were pretty high, I would say around 1.3 trillion, there was sort of a crunch for reserves because of the reduction in their balance sheet that caused the repo market to become very volatile. So a combination of factors sort of led us to believe that perhaps policy was a little bit too tight. Balance sheet and excess reserves were probably getting scarcer. And that caused that sort of reversal in the directionality for rates. And the Fed had to quickly cut rates to stabilize the economy. And then again, the next leg lower during the financial crisis. During the crisis of the pandemic.
You'll know this a lot better than I would, but as I'm recalling back to that late 2018 period, there was the Fed, of course, reducing its balance sheet, but other big central banks were as well. And there was some discussion of the aggregate impact of balance sheet reduction. Just with that topic to go on here, when you look at this concept of balance sheet reduction and its impact on rates or on risk appetite, perhaps it's psychology. Of course, we're coming up on a potential tapering cycle. How does it figure into your calculus in terms of impact on risk-taking and sentiment?
So the balance sheet right now is extraordinarily large, right? So tapering doesn't really reduce balance sheet. It just reduces the pace of the expansion of the balance sheet, as you know. So we're still adding to the balance sheet every month at the pace of around 120 billion in purchases in treasuries as well as mortgages. And the expectation is that at some point later on this year, the Fed will announce a tapering of asset purchases. So they'll gradually pare back their monthly purchases till they stop purchasing assets, perhaps sometime by the third quarter of next year, 2022. And at that point, the balance sheet will remain unchanged. And what the Fed will do is if there's any maturing securities, they'll reinvest it back into their portfolio so that the SOMA portfolio size remains unchanged. The balance sheet right now is very large. Like I said, it's going to grow over the next year, and it's going to perhaps remain stable for a while the Fed is tightening monetary policy by way of raising rates. So as that happens, I think some point, probably not in the next 2 or 3 years, when conditions become suitable, the Fed might think about paring back its balance sheet. But for me, at least for the next several years, I see the balance sheet being quite large. And I see that excess reserves are probably going to remain large for the foreseeable future. So really the next leg of tightening after the tapering of asset purchases is going to come from raising rates.
We talked a little bit about that early 19 period where the market started to essentially revolt against the Fed. I remember the short end of the yield curve inverted a little bit, sort of a telltale signal from the market that the Fed may have done too much. And I'm just curious, and just in terms of the market-based signals that you look at, whether it's shapes of curves, things like the break-even market, how do those make their way into your process? And then alongside that, just with the Fed being a participant in the market, how do you look at those indicators maybe stripped of the distortions that the Fed may be imposing? How do you get confident in the signaling effect or the signaling impact of, different indicators?
So as you rightly pointed out, I think the inversion of the yield curve in 2019 was a very, very important signal because typically in the past, going back decades, anytime the yield curve is inverted, about a year after that, the economy, GDP closed down quite dramatically and the economy tends to go into a recession. And that's exactly what we were calling for at SocGen at the time. Not just based on the inversion of the yield curve, but also corporate profit margins. And if you look at those corporate profit margins, they typically tend to peak somewhere in the middle of the cycle, and then they start compressing towards the end of the cycle. And that's kind of what we saw. And those were the metrics that we were looking at to make the call for a recession in 2020. And of course, we did get a recession, but it was mostly because of the pandemic and the shutdown of the economy that happened in March of 2020. But we were kind of heading towards a meaningful slowdown as early, I would say, as the beginning of 2019. There were clear signs that the economy could slow down quite meaningfully and potentially go into a recession.
And if you look at the sort of Fed's participation in the markets post-pandemic, as you're commenting on the size of the balance sheet and its just commitments to hold rates low, at least the policy rate, what are the indicators or the metrics that you feel need to be looked at with some degree of, I don't want to say skepticism, but just looking at them closely in light of the Fed being a part of it? Some people talk about tips as a market that the Fed has been a huge player in. What are the distortions that you see currently in prices?
Well, I mean, the Fed asset purchases, are designed, if you will, for risk taking, and I would say to encourage investors to go out at the risk spectrum. So what the Fed does during any sort of large scale asset purchase is that it buys treasuries across the curve and grows its portfolio. But the impact of buying treasuries across the curve is interest rates, not just in the front end because policy rates are at zero, back end interest rates are also declining quite meaningfully, and the curve is somewhat flatter because of that, and artificially so because of the fact that the Fed's buying, treasuries across the curve. So what that does is it compresses term premia. It sort of disincentivizes, if you will, the markets from holding treasuries because treasuries at some point start looking very rich relative to fundamentals. Like right now, 10-year treasury yields at 130 when you're looking at growth for this year in the context of 6.5% to 7% and inflation perhaps well over 3% does not make any sense because those are inputs to any fair value model. And if you use those inputs into a fair value model, models will tell you that 10 yields have to be perhaps 20, 30 basis points at least above where they're trading right now, across the curve. So what that does ultimately is that investors start putting their money into risky assets in search of returns. So you see more demand for corporate bonds, you see more demand for emerging market bonds, you see more demand for equities and other risky assets. So that process is called the portfolio balance channel. And that's kind of what the transmission mechanism is for quantitative easing.
I just came across a chart, it was posted by Deutsche Bank. I think it was on Twitter somewhere, and it showed that 80% of the U.S. high yield market is trading with a negative real yield. So the nominal yield is below the concurrent rate of inflation. And, of course, we don't think inflation is going to stay at 5 or 6%, so it's probably overstated, but it kind of hits you over the head. The amount of financial repression that's in some of these prices. I'm just struck by the way in which the 10-year can continue to trade at 120, 130, 140, take your pick of yield, set against, as you say, these growth and inflation dynamics. What do you think is going on there? How can we get such a discrepancy that doesn't seem to be going away anytime soon?
So that's a very, very interesting point that you pointed out, Dean, which is if you look at even high yield bonds, which are yielding around 5%, and yes, you're right, 5% is not inflation right now, might be 4 or 5%, but that's not where it's going to stay for the foreseeable future. So if you look at inflation adjusted returns or real returns in treasuries, and I would say a majority of the bond universe, the returns look quite unattractive. For instance, 10-year real yields in the U.S. are negative 1%. So really it doesn't make any sense from a return perspective to hold 10-year treasuries at these yield levels. We think that they're very, very rich. But sort of, to your broader point, I think that the reason why yields are so low is because there's just a lot of cash in the sidelines. Money is being put to work in equities, in high yield, and in other risky assets. And it's also making its way into treasuries. But there's also other dynamics at play. So if you look at 10-year treasury yields at 130 versus, say, yields in Japan or in Europe, where they're negative and very, very low, for foreign investors, especially in Japan and Europe, 10-year yields look very attractive on a currency-adjusted basis. So we tend to see a lot of demand from foreign investors, especially asset liability managers who are looking to put money to work, pensions and insurance companies. They find yields in the U.S. to be very attractive on a currency-adjusted basis, given the fact that policy rates there are negative and general level of yields are significantly lower than where they are in the U.S. So those, I would say, are the two contributing factors to why yields are so low.
Yeah, it's almost as if the 10-year is just another risk asset, not in the traditional sense, but its price just may reflect the amount of capital that has to find a home. And there's only so much money you can stuff into a bank account before the bank tells you no more. So it's quite interesting. And, if you step back, as you mentioned, the negative 100 bips of real yield on the U.S. Treasury doesn't sound like a good deal. And so I just think, okay, are there vulnerabilities from that becoming unwound? Not to suggest it will, but, there's certainly people thinking that you're supposed to have some hedge or defensive trade in your portfolio that reflects the vulnerability to sort of the system of assets that effectively are ultimately priced off of this incredibly low 10-year yield. And I don't know if that's the case or not, but there's certainly people that have that trade on. Does that strike you as a vulnerability? I know in some of your work you think rates are going up, but you think they're going to go up on a relatively measured basis and maybe stop at 170 or 2%. Tell us how you sort of see this playing out.
So I think that is a vulnerability. I think that real yields are very low. If you look at, say, the 2013 timeframe and the taper tantrum, we saw a very sharp rise in real yields, and inflation expectations remained relatively unchanged, and then nominal yields also rose. So I think real yields, broadly speaking, in the U.S. are very low, and they should reprice higher as the Fed steps away from the market. But I also see inflation risk as a key vulnerability in the markets. Inflation expectations have risen quite meaningfully in the last year. 10-year break-evens, for instance, are around, say, 230 basis points or 2.3%. So the market's pricing in, say, above 2 to 2.5% inflation over the next 10 years, which is, quite on the high side. But we've never been in a situation since at least the beginning of the TIPS market where we've seen inflation in the context of 4 to 5%, and we haven't really seen any period of time when there's been persistently high inflation. So, yes, everybody believes that inflation is somewhat transitory, but my concern is that if that proves to be wrong, then that's definitely a vulnerability that I think is underpriced in the market. So I would recommend that investors have some exposure to this scenario by way of being long break-evens or having some sort of an inflation hedge, if that were to be the case. And the things that I'm watching closely are the more persistent sources of inflation, things like wages. I mean, we know that there are 10.1 million job openings and perhaps 7 or 8 million people that are unemployed. So there are labor shortages in the market that are leading to wage pressures, medical care costs, things like rents. These tend to be somewhat more, and supply chain disruptions, broadly speaking, tend to be more persistent sources of inflation. And we sort of in the midst of it, and we're hearing a constant drumbeat from corporations and CEOs that they're not able to source materials. So I think that these sort of supply chain disruptions are somewhat here to stay, and that could continue to put some pressure on inflation well into the beginning of next year. And I think that that's a risk that I'm kind of tracking closely because that has implications for monetary policy. The Fed could very easily come in as early as the second half of next year and start to hike rates because they're concerned about the persistence of inflation. That, again, I think is an underpriced risk in the market. So there are lots of vulnerabilities as we evolve and get a better understanding of the dynamics of the pandemic.
I wanted to get your take on this, and I think you alluded to it just now, this idea of behind the curve. It's an old saying that hasn't been used a lot recently, at least with respect to the Fed. I thought Mohamed El-Erian has done a nice job of framing just the risks that come from average inflation targeting, which is a wait and see. Let's not predict, let's not forecast. We don't think that that's very easy, and we're just going to sort of take the view that show me the money, show me that inflation can go meaningfully above 2, maybe 2.5, and then perhaps we'll think about doing something. And that seems to be a back-ended kind of response that might require more movement in a hurry. Is that how you're thinking about at least that low probability but high impact risk?
Yeah, I mean, I think that typically the Fed has actually, since the financial crisis, held a very cautious stance on policy normalization. I mean, they really didn't rush into raising rates after the financial crisis. Again, going back to 2013, when the taper tantrum was happening and the market was expecting the Fed to taper asset purchases, the market was very quick to price in hikes very soon after that. Then it turned out that they were raising rates at once a year, after 2013 and, 2014 and 2015. It was just the hikes were very spaced out. So the Fed feels that, at least from their own perspective, they feel like they can err on the side of caution, given the fact that over the last decade, inflation has actually been well below its target or struggled to get to its target of 2%, that they're more comfortable keeping policy rates lower for longer than rushing into hike rates, because they feel that if there's a decent amount of growth they feel that they could easily come in and raise rates to prevent runaway inflation. So they've always erred on the side of caution and kept, policy rates on the low side. So that could potentially lead to perhaps a rush to normalize policy, but they see that as a good problem, not as a bad problem. So I'm not one to jump in and say that we're going to have a policy mistake, but it does feel like the time is right for them to taper asset purchases and perhaps think about, policy normalization over the upcoming year.
You mentioned looking at swaption vols, and you also mentioned positioning. And I've seen in some of your work discussions about systematic vol selling. We're all in a world of zero interest rates, just trying to earn a couple nickels. Perhaps selling vol is one methodology to do that. I certainly see plenty of that on the equity side. In terms of vulnerabilities in the rates market and this kind of overlay of systematic vol selling, it sounds like it's concentrated in the shorter end maturities. Tell us a little bit about that, just in terms of what you see there and if there is some degree of vulnerability.
Yeah, so that's definitely been a strategy that many asset managers and hedge funds have employed over the last, I'd say, decades even, because, getting short front-end volatility and sort of rolling that short is sort of a very good carry strategy. Of course, there are periods of time and months when you're probably going to regret that strategy because you see a sharp rise in volatility because of a risk event, but mostly that sort of strategy works well. And it's worked particularly well, I would say, because monetary policy has been very, very predictable, and the Fed's taken a very, very cautious approach to policy normalization. This is not the mid-90s when the Fed would come in and raise rates by 50 and 100 basis points in one shot and by surprise. I mean, monetary policy is extraordinarily well televised, if you will. So that's sort of helped the strategy. But this year, I would say, has been somewhat different. Implied volatility has, especially with the sharp sell-off in Treasuries in the beginning of this year, we've seen that implied volatility, for the most part, has remained relatively high. And that's kind of kept some of the investors away from these systematic vol strategies. But you're starting to see more of that in the summer and in the recent months because policy is becoming more predictable.
What about on the yield curve? So we referenced that a little bit as well. And there are some folks that just think that if and when the Fed ever does get around to initiating some degree of policy tightening, they'll do it, as you are suggesting, in a very measured way, very predictable way, and that we're not going to see a lot of movement in the back end, that you'll just see curve flattening. I'm going back to 2004. I mean, that was a policy tightening that I think over the course of 3 years, the funds rate moved up maybe 300 to 400 basis points and the 10-year barely budged. That was the original conundrum. What do you see if and when we do ultimately get to that incremental policy tightening regime? What do you see in the back end?
So that's a very good question. And I think that's, in some respects, that's why I think looking back at previous rate hike cycles might not be instructive, because the curve never got that steep in recent history because of the fact that the Fed has been very involved in asset purchases across the curve. I mean, if you go back to the 2011, 2012 period, I mean, after the successive rounds of QE, what we saw was the Fed was engaged in Operation Twist, where they sold front-end securities to buy back-end securities. So that's always something that's sort of weighing on investors' minds, in the sense that if they do get done with QE and they want to provide additional accommodation, the Fed can, potentially do the same thing where they focus more of their asset purchases on the back end. So I think that's why the market's somewhat reluctant to steepen out the curve. But I think for a healthy market, I think a steeper curve is a sign of general health. I mean, banks and financial institutions thrive on the steepness of the curve. I think carry trades are positive. And people want to see some term premium for them to be able to hold longer dated assets. So I think those are all healthy signs, but now I think that they're being artificially kept low because of the Fed's policy on asset purchases.
You mentioned inflation drivers earlier, and I was hoping just to explore that a little bit more. I just remember, you watch the Fed more closely than I do, but I just remember Yellen's comment from maybe 2017 or so, and it was something to the tune of inflation is a mystery, which doesn't give you a ton of confidence. Seems like a lot's resting on this. But you mentioned wages, which is quite interesting. I saw there was a New York Fed survey that seems to be getting some attention about consumer inflation expectations. And I think that over a 3-year horizon, this year it's gone up a full percent from 3 to 4%, which I think is a fair increase. How do you think about just the inflation expectations component, the psychology component? Is that something that gets enough attention, too much attention? How does it fit into your inflation framework?
No, I mean, we look very, very closely at inflation expectations, not just what's implied by the TIPS market, but also, like you pointed out, survey-based measures of inflation, like the Michigan 1-year and longer-term inflation expectations that come from the Michigan survey, because those tend to give us a very good sort of mix of signals from, what the market's pricing in, as well as what, the surveys are saying inflation is going to be over the longer run. And the market's still not very concerned about runaway inflation or persistently high inflation, because 10-year break-even at 2 to 2.5%, like I mentioned earlier, is not really out of the context of the past. I mean, that says that there's going to be a healthy level of inflation over the next 10 years. I'd be more concerned if that number starts to go up to a 3% or higher, because that's not where it's been since the beginning of the TIPS market. So I think it's very instructive. I think that's a very important metric that the Fed tracks very closely. They want inflation expectations to go higher, but they don't want the expectations market to signal runaway inflation. So, it's definitely a very important metric, and we track it closely. And I think all investors are starting to pay a lot of attention to it.
Well, that's a vulnerability, of course, which is this transitory debate. Turns out to be this is a much higher, a meaningfully higher inflation environment that's not transitory and becomes a problem for the Fed. You mentioned the Delta variant. What are, just as you kind of look around the world for vulnerabilities, the types of things that can upset what really is a pretty low vol environment? I mean, across almost every asset class these days, maybe not crypto, but most of the traditional asset classes. What are the derailers? What are the things that keep you up at night, just in terms of causing some concerted risk off that, puts investors in a very tricky position?
So I think that the virus and the surge of infections is probably here to stay with us for the foreseeable future. But I'm generally optimistic, given the fact that as time goes by, a larger and larger population of the world has access to vaccines and is getting vaccinated. So, mobility rates should improve over time under those circumstances. So I actually am somewhat more optimistic, if you will, on the Delta variant. The risks of runaway inflation, I think inflation should be transitory, but I worry that it's going to remain more persistently high for longer than people expect. And, broadly speaking, I think the removal of accommodation, right, both monetary as well as fiscal accommodation, could have some impact on tightening of financial conditions over the coming years. I mean, we've seen tremendous growth in the last couple of years, especially this year and next year, perhaps, because of these extraordinarily accommodative monetary policies and just tremendous amount of fiscal stimulus. So withdrawing some of that stimulus could have an impact on growth. But I generally see that as having more of, all of these sort of risk factors, in my opinion, are going to be something that sort of drags out the expansion a little bit, as opposed to being something that's going to be more, dramatic and abrupt and disruptive, if you will.
I'm seeing in some of your work some reference to the debt ceiling. I'd love to learn a little bit more about how you and team are incorporating that. I know you referenced that it's starting to show up in some of the T-bill maturity prices. How do you see that?
It's actually one of my least favorite topics to discuss, because it recurs. We see the same thing every single time and every, few years. So it's very much dependent on policymakers. The bills market seems to be pricing in for some sort of a debt ceiling deadline around the end of October. But you're not really seeing any of these discussions in any other markets, or even the rest of the Treasury curve besides the market. So the expectations broadly are that some sort of a suspension of a debt ceiling, or a resolution, if you will, either temporary or longer suspension, will happen well before the deadline, because you clearly don't want to see the US go into any sort of a technical default. So I think that this is, again, going to sort of drag on, if you will, to the deadline, but there will be some sort of a resolution before we have to deal with any sort of a technical default.
Yeah, I'm just remembering back to that famous 2011 self-imposed debacle between really John Boehner, and Obama. They really took that one to the edge, and that certainly showed up in markets. What was so curious about that was, as the U.S. was on the brink of a technical default, of course, the bond market rallied ferociously, in an equity risk off.
That is very true. It was kind of one of those things where the bull market was going crazy the other way, and then the rest of the market was seeing a flight to quality.
Right. Yeah. So interesting. Well, we've covered a lot. I'm curious, just, the pandemic was so many things, obviously such an ongoing, an awful experience for the world. We continue to try to recover from it. There's been an incredible rescue program, both by the Fed, certainly on the fiscal side. There's been a lot of very necessary deficit spending, which is ongoing. What's changed, just in terms of, if you think about the types of things you'd look at that describe your view of the world, in January of 2020 versus now, what are the big differences in terms of how you look at the world?
So I think we look at a very different set of metrics in sort of gauging what the future holds for us. I mean, like I mentioned earlier, we focus on what's happening on the virus front. Supply chain constraints are a very important factor that we look at. We also track mobility rates very closely in the US as well as globally in coming up with our thought process. And now, like you mentioned, there's still more work to be done on the fiscal side. We're expecting some sort of an infrastructure package to be passed. We're also expecting, perhaps $2 trillion to $3 trillion in sort of human capital or human infrastructure spending that could be passed via reconciliation. So there's still a lot more that could come on the fiscal side. It's not going to be as concentrated in a very short amount of time like the relief packages that we got after the pandemic. But this is going to be a decent amount of spending that's going to, come in the next decade. And the impact of that on debt and deficits is something that we'll be tracking very closely. And the impact on growth and inflation.
It seems like there's certainly a different philosophy in many cases post-pandemic, just with the degree of fiscal spending and even the Fed. It's broadening its remit in some ways, perhaps maybe not actually on paper. You still have that same dual mandate, but it's incorporating things like minority unemployment rate. It's taking a more expansive and inclusive view on whether it's achieving its objectives. Does that come into your calculus as you sort of think forward about the Fed and how it acts and what it's trying to accomplish? Is this trying to forecast the way in which the central bank operates in a post-pandemic world and how different that might be versus before March of 20?
Absolutely. I think that the key metric, as you know, for the Fed to be able to announce tapering of asset purchases is they want to see substantial further progress on employment. And what they're looking at for substantial further progress is they want to see a much more equitable, change in the unemployment rate. So things like Black and Hispanic unemployment rates and other metrics become much more relevant. I should say they've always been relevant, but they're much more important from a monetary policy perspective than they've perhaps been tracked in the past. So those are some things that I think that the Fed is looking at very closely. We are, as market participants, also looking at much more closely to sort of gauge if the Fed feels like they've made substantial further progress. And I think that these are very important goals. If you look back at the key difference between tapering now and tapering back in 2013 when the discussions were happening, the unemployment rate was a lot higher. It was around 6.5% to 7%. Now the unemployment rate is a lot lower and perhaps heading lower, and yet the Fed doesn't feel like we've made substantial further progress on employment. So these metrics are very important, as they should be. And, the problem is that the Fed, with its policy tools, is not able to specifically target this, except for sort of maintaining a much more cautious stance on monetary policy. So monetary policy, in some respects, is a very blunt tool, if you will, in addressing some of these socioeconomic issues.
Yeah, I think it's such an open question. It's something I personally struggle with, which is, as people like you and I inside the markets and just looking at how people take risk, you talk about words like carry. That's kind of what makes the world go round in our business. And asset prices are profoundly impacted by the Fed. That's why we spend so much time studying the Fed. And it just seems a disproportionate impact on the financial economy, certainly a positive impact on the real economy, but it does feel disproportionate to the financial economy. And so there's a lot of conversation about the inequality debate and the Fed's potential role in it. They take the opposite stance. I think it's unsettled. I'm curious, do you have a view on that with respect to the Fed's potential role on the inequality side?
Well, this goes to the point I was making earlier. The monetary policy in general tends to be a very blunt tool. If their focus is their full employment and price stability, and the tools that they have to implement their dual mandate is reducing policy rates, which they've brought down to zero, and doing sort of quantitative easing, which, eases financial conditions because rates across the curve are quite low. And it also encourages risk-taking. And what that does is it sort of benefits, if you will, and exacerbates some of the inequalities that are already present. But the final objective for the Fed is, of course, to make sure that policy remains accommodative till the point where people are back to work and we're approaching, or at least on a path towards, full employment. But unfortunately, like I said earlier, I just don't think they have sort of targeted tools to achieve these goals.
Yeah, these are very difficult challenges. Well, I wanted to end our call with a solicitation of your views on the state of progress for women in the financial industry, the financial markets industry. You're a prominent woman in the markets, and there's been some efforts along the way. It seems like those efforts actually increased to try to increase the participation of women, give women a greater voice in the industry. It's an open-ended question, but I'm just curious if you could share with us your perspective on that, the progress that's been made, what needs to be done, what some of the hurdles are. How do you see that?
So there's definitely a lot more attention. I can say that in my firm, as well as, the industry at large, towards, sort of recognizing talented women, promoting them, giving them the opportunity to manage and lead. So that's definitely a huge positive, if you will. But really, the problems for women in the financial industry is much more about sort of not just getting them through the door and hiring a lot of women, but retaining them over the years. So retention is where I would say that a lot of work needs to be done. Typically, if you look at analyst and associate classes in any of the larger banks or even, buy-side firms, they tend to sort of equally weight men and women. But as time goes by, by the time you get to sort of a VP level, you tend to see attrition starts to pick up, and it's much more among women than men. So I think that there needs to be a little bit more attention paid to that and sort of focus on sort of retaining talent, if you will. And, it's quite unfortunate that we haven't made as much progress in my career, but I'm kind of hopeful for the future.
I've heard very much what you just articulated there, just around with an equal number starting, but then it kind of fading, women just getting to a certain level and then perhaps not continuing. So hopefully some progress on that front can be made. Well, Subadra, I want to thank you for taking the time to share your views with us today. Definitely a interesting conversation on all the variables that we're thinking a lot about: growth, inflation, pricing of rates, the direction of rates, the Fed. I think we covered a lot of ground here, and I'm grateful for your insights and for you having been a guest today.
Thank you, Dean. I enjoyed speaking with you.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.